we live in unprecedented times. And I think it's hard to really understand just how crazy and such what a singularity 2026 is. So with this video, I'm attempting to show that and demonstrate how rare this moment in history is. So we're currently in one of the biggest infrastructure buildouts of all time. We have the second highest valuations of all time, relative only to the dot-com bubble. We have the highest total debt burden of all time. We have arguably the highest leverage of all time. We are in currently the biggest energy disruption of all time, and that shows no sign of fixing or correcting itself. And we are going into and currently in the biggest weather event of, as far as we can tell, all time. So let's go into each of those in a little more detail. So I have this chart here of infrastructure buildouts. We got the years, we got the annual percent of GDP, we've got the single peak year, we got the percent of the market share, and we have peak to trough, and then we have a little bit of background on each. And I like to measure everything as a percent of GDP because it makes comparisons across time periods relevant to each other. So the biggest one of all time was the railroad expansion. This led to the biggest depression of all time in 1872 when the market crashed and there was a contractionary period of 60 months, which is beating the Great Depression, which is caused right at the end of the electrification era. That was a 40-month contraction. This is a 60-month contraction. And you can see railroads were very concentrated. They basically were the market at the time, whereas electrification was much less concentrated, canals much less even so. But all of these are ranging around 80 to 90% drawdowns. Currently, we are at very high levels of concentration, a concentration that hasn't been seen except for this crash caused by the railroad expansion. So the point I want to make is all of these are technologies that we use regularly, and they're very useful, but that did not stop any of them from dropping 80 to 90%. And this is within the core indices. So this would be within only railroads. This is within electrical companies. This is within the canal holdings. This is within the energy sector. And this is going to be within AI. So it seems reasonable to expect at some point in the future, hard to time when, there's going to be an 80 to 90% drawdown in AI stocks. Okay, I have another chart. This one is showing much smaller build-outs just as a percentage of GDP. You can see that these percents are much smaller, ranging from 1.5% to 0.5%, while these are ranging from almost at the peak 6% to 1%. And currently AI is coming in at 2.4%. Not very many things are higher than that. Only electrification leading to the Great Depression and railroad expansion. And this one was a kind of state funded, not in all ways, but it did also lead to a large recession. Okay, so I have some stats here. So the average concentration for the industry was 26%. So 26% of the market was just that industry. And we have 10% for minor build-outs like these. And then the average drawdown was 84%. Now AI is not at a 26% concentration. It's at a 50% concentration. So it's much more concentrated than many of these. Okay, so let's go into overvaluation. I said we were in one of the most overvalued markets ever. So a couple of metrics. Price to book is the highest it's ever been. Price to sales is the highest it's ever been by a 1.5 times multiple. And the concentration, the top 10 weight of the index is the highest it's ever been. by a huge amount, beating .com at 26.6%. Currently, we're at 41%. 41% of the S&P 500 is 10 companies. That's insane. So here we have the Buffett indicator. This is GDP divided by the stock market, pretty much. So the stock market is worth 230% of GDP, about 230% of GDP, and it peaked at maybe 150% of GDP in .com. And this is Shiller PDE. So it's the PDE if you look at the earnings over the last 10 years. I mean, it's an inflation adjusted metric. So .com was the all-time high at 44%, very notable peak going into the Great Depression over here as well. And we notched a high of, I believe, 42.1 going into when S&P hit 7,600. That was about a month ago. So debt levels. I said we have the highest aggregate debt of all time. That's not necessarily true. You can see that debt levels are very high. Government debt is the highest it's ever been. That is just a fact. But household debt and corporate debt are slightly lower. This is household debt and corporate debt. I guess government debt was very marginally higher right after COVID because of the stimulus, and then they had some quantitative tightening right there. But corporate and household debt are still very elevated. And the current aggregate debt as a percentage of GDP is 271%, beating out 2008, which was fundamentally a debt crisis, and only just marginally losing to 2020. So let's talk about leverage. I saw a graph recently, which I unfortunately couldn't fit on this slide, that showed our margin debt to GDP, and the only period in time where it was ever higher was going right into the Great Depression in 1929. It reached 10% of GDP. Currently, we're at a historic 5% of GDP. And then we have other forms of debt too. We have SPVs, special purpose vehicles, and off-balance sheet debt, where the tech companies are not necessarily reporting it. They have these special localized instruments to hide, their obligations off their balance sheet. But that doesn't mean that they're not paying for it and that they're not obligations. So total, we have about 5% in margin debt, which is the worst kind of debt, because it's very likely for margin debt to cycle, right, and to feed into itself. And we have 2.2% of GDP in off-balance sheet, SPV, circular financing type debt. And then we have derivatives, which we're going to go over on the next slide. Here I have a picture of the Kospi. So the Kospi is a crazy story of historic concentration and leverage. And people say, the Kospi is incredibly concentrated, which is true. Almost more than half the index is made up of just two companies, Samsung and SK Hynix. But the leverage amounts, despite the stories, are not very high. There's only 1.2% margin debt to GDP. That's even less than we had going into 2008 right here. I think this figure is about 2% of GDP at the time. And it lost 40% of its value in the last month. So this is a, kind of a leading indicator, perhaps, it's hard to say, of what's coming to, AI in the US. And 40% in 1 month is crazy. That's even faster than the COVID crash, which it took 90 days top to bottom, I believe. So this is the most complicated slide, and I'll try to make it simple. Derivatives are the most dangerous type of leverage. Derivatives are what caused 2008, where you have the housing crisis, but under the housing crisis, you have derivatives. And what a derivative is someone makes a bet on the outcome of something happening. In the housing market, the bet was on the outcome of people paying their mortgage. And when people stopped, those bets all went bad, and they were liable to pay a lot of money. But there's also other types of derivatives. There's two very important ones. There's interest rate derivatives, and there's foreign exchange derivatives. And since 2008, these have exploded in value. The value in 2008 for interest rate derivatives was half, I think, what it is now. And just between these two types of derivatives, the value is about $850 trillion, which is an insane amount as a percent of GDP. So it's hard to measure exposure to these types of derivatives, as a lot of them cancel out. But when you have very rapid changes in the value, let's say someone rapidly hikes interest rates, or you have a currency collapse, that causes a rapid change in the value of the derivative, and it causes drag, it causes margin calls, and it causes a feedback loop where you can lose a lot of money. And 2008 is well known as the credit default swap crisis. And I have here 2008 versus 2020. You can see 2008, we had a lot of losses due to CDOs as well. But most of the losses were not in credit default swaps, they were in interest rate derivatives. Because the interest rates rapidly collapsed. There was a hiking cycle going into 2008, and then we rapidly cut rates. And that created a lot of volatility for the interest rate derivatives, which since then have more than doubled in size. I think going into 2008, interest rate derivatives alone were about, I believe, like $200 trillion. And now they are $665 trillion. And foreign exchange has also rapidly increased since then. The only thing that has rapidly decreased is we've delevered on credit default swaps. So we have less exposure there. Those are housing related. So total, it's hard. These are very approximate numbers, but total, we could be looking at a leverage ratio of about 80 to 95% of GDP. So let's get into the energy crisis. So here I have a list of energy crises, and on the side I have averages. So the average return of oil from most across all these energy crises was 94%. Oil doubled, essentially, across all these crises. And the average duration was 7.25 months, and the average disruption was 4.5 million barrels a day, and the average cumulative block was 550 million barrels, and the average percent blocked was 8% of global supply. Let's compare that with Hormuz. So Hormuz is closed. They recently just closed the Caspian pipeline to the Caspian Sea, and Mandeb is kind of pseudo-closed. It's not really clear what's going on there, but it might be closed. They also hit a very large processing plant in Saudi Arabia, which handles 7% of oil of the world flows through that processing plant. But okay, let's look at these numbers. So 22 million barrels. That knocks the socks out of any of these other disruptions. And it beats the average disruption by a multiple of 5. And 21% is more than double any of the previous shocks. This is the second biggest shock, and it's about double the size of that shock. It's only been going on 6 months. Who knows how long it'll go on? But even in that 6 months, it has still disrupted the most ever, more than an 8-year conflict between Iran and Iraq. So, I mean, this disruption is unprecedented. And what have we seen in terms of appreciation from an unprecedented conflict on by every possible metric? Well, we've seen an appreciation of oil prices of 26%. The average appreciation is 94%. And we've seen a 26% appreciation. The market is not pricing risk like it did in the same way that it did during these shocks. So that's interesting. All right, let's move on to the largest weather shock in history. So this is the global average surface temperature. You can see it's pretty much going up and to the right. And a huge amount, if you look at the last 20 years, 10 of the hottest years, they've all been in the last 20 years. Every year it keeps getting hotter, and El Nino is a warming cycle on average for the globe. And let's compare it. These are the biggest El Nino events of all time. We have a 2.6 degree hot spot. These are ocean temperatures where El Nino originates. So 2.6 degrees in 2015, 2.4% in 1998, and 3 Celsius in 1877. And the model is showing this is 3 degrees, right? It looks like the average to me. This model was made, I think, in late June. It's showing that we could get upward of 4, and perhaps an average, maybe that's around 3.8. So, I mean, there's no words for this. This is historic, and we're going into it with a different backdrop, a fundamentally hotter backdrop, and 30% of global fertilizer was trapped in the Strait of Hormuz. And those plants are in the ground, right? That's that ship has sailed, right? So we're going into this weather disruption already with depleted fertilizer levels. Finally, I kind of want to add a little piece about how I think about markets. So I've studied a lot of crises, and a crisis is usually not one thing, right? It's usually many, many, many things coming together. Like a pattern you'll notice is usually with a crisis you have a few things. You have leverage, you have debt, you have infrastructure build out often, and you have there's a few other things, but I'm blanking on them right now. Like high oil prices is one. Like going into 2008, you had high oil prices. Going into the Great Depression, you had this giant build out combined with leverage. Going into 1872, you had a huge build out, the biggest in history, combined with leverage on that build out, combined with, I think there was an oil shock as well. So these high watermarks that we see in our past, they're not caused by one thing. They're caused by the merging of many, many, many different things together. And a principle that is similar to that is rogue waves. They didn't used to believe that waves, these are in meters, 16 to 20 meters were possible in the ocean. And they didn't believe that until one hit in 1995 in Norway on an oil rig. And the process through what they're created is constructive interference. And I believe that we're in a time where it's very likely, it's very possible that these factors could constructively interfere with each other. Now I'm going to briefly go over some leading indicators. Leading indicators are good if they signal deeply and they signal before recession. So I want it to show before the recession starts. So this one is one of the best ones. It's private residential investment. You can see it starts signaling way back in 2006 going into GFC. It starts signaling right over here, right before this crisis. Didn't really signal in 2000. Had some very mild signals in the 80s and a very mild signal in the 70s. And right now, I would classify this as a mild signal, right? We're off our peak, which is historically quite rare to be off your peak. It's not the massive signal that we saw in 2008, but this is not fundamentally a housing driven crisis like 2008 was. But it's definitely not a good sign to see this weakness in housing. This is another housing related one. This one signals pretty deeply. This is new privately owned housing starts, units started. So you can see this signals pretty deeply before the recession. You can see a huge signal in 1975, some big signals here before the recession starts, a long signal lasting almost like 5 years, I would say, 10 years almost, going into 1990, no signal in 2000. This was, again, an infrastructure build out similar to how we're seeing. But what do we see? We see a slow and steady decline. It reminds me of this period going into 1990. So it's kind of like we're combining this recession with this infrastructure build out recession. And remember, this infrastructure build out is already bigger than the infrastructure build out in 2000. As a percentage of GDP, as in terms of total investment, it's already bigger despite having lasted less time. So that's not good. And this is the final one. This is investment in equipment, a lot of trucks, it's corporate investment mostly. Does signal very marginally before the recessions. You can see some slight signals here. And what do we see? We're off our peak. Again, it's not like a huge deal if you're off your peak, but it's not particularly common to be off a peak and not have some sort of correction, some sort of recession. And taken together with all the other data, it's not a good sign, I would say. So let's go into our last slide. So what do I expect to happen? It's hard to exactly predict the future, obviously. But I'm expecting you have this very concentrated market. The market is super concentrated in big tech and hyperscalers and semiconductors. And I'm expecting that to rotate out into kind of beaten down sectors. So you have software, which is jumping like 20% in the last like 5 days, something ridiculous. You have probably the Russell 1000 is going to do well. Maybe gold will do well. Maybe the dollar initially will do well. Treasuries will probably, bonds will probably do well, initially at least. And REITs, commodities, cash generating assets, things that people want to see the money. When they're scared, they want to see the money. So they're going to rotate it out into that. And then you're going to start seeing real problems. And keep in mind, these things take months and months and months and months to happen. So it could happen a lot slower than it sounds like just listening to me right But slowly you'll start to see projects falling apart, projects being canceled, and over leverage will start to be apparent. You might see some major bankruptcies associated with that. Like Oracle is the obvious example of a company that could and potentially will go under, especially if OpenAI or Anthropic are not able to pay their debts. And this will cause broader panic. And then all of these things that I described earlier will probably start selling off as well, because people just don't want to be involved at all at this point. And things will fall very rapidly. And then in response to that, the Federal Reserve will cut rates very low, probably under 1%, and they'll start printing. And if you just look at the trajectory of how they've printed during previous crashes, every time they print more. And my best guess is just a guess, is that they're probably going to print in the neighborhood of $9 trillion, which would put us in the neighborhood of 150% of GDP. And this action of cutting rapidly and printing huge amounts of money puts a huge amount of stress and strain on IR and FX derivatives, because IR measures interest rates and it's sensitive to rapid cuts, rapid hikes. And FX measures the value of currencies in relation to each other. And we already see Japan, right? The US just yesterday announced that they were going to intervene to defend the yen. Japan has been intervening to defend the yen. So their currency is currently going through it right now. But the US currency in this case could rapidly be devalued because it's fundamentally reliant on the market trusting it, on people holding US Treasury bonds and dealing with US dollars. And if the US prints $9 trillion, the US might, the world might decide that they don't want to do either of those things. And there's a potential for a lot of instability around the dollar. And these IR and FX derivatives could add potential losses of $20 trillion as holders are margin called and they're forced to sell. And I think I already talked about this. Extreme debt burden of the US government has the potential to trigger a currency crisis and a loss of faith in the dollar, and other countries divest from US assets. So none of this is guaranteed to happen. But for me, things are real simple. Like, you just break it down in these terms and you think about the situation that we're in and you ask yourself, are these risks I want to personally take with my own money? Are these risks I want my country taking? And the answer for me is pretty obviously no. I don't want to take these own risks with my own money. I would rather, if I could do anything to stop it, I would not want my country taking these risks. But that's the situation that we're in. So we best go into it with our eyes open. Thanks. I hope you learned something.